So once you understand that you can buy the rights and you sign that option agreement, technically what happens is you get an equity share of that property. Now, it's a very minute equity share. It's not a controlling equity share. But because you have that equity share, you can go sell this property and don't need a license.
Are you ready for a successful retirement? We're addressing the topics facing today's retirees. Welcome to Retire with Ryan. Now here's your host, Ryan Morrissey.
Welcome back, everyone. I'm really excited for this week's guest. I have Bill Hawthorn here, and Bill's here to talk to us about 6 non-traditional ways to make money from real estate. Welcome, Bill.
How are you today?
Good.
Good. I'm excited to be here with you.
Me too, yeah. Bill and I met each other actually through a podcast group that we're a part of. And when I first became aware of everyone's podcasts, I went and listened to some of these other episodes. And Bill's podcast is on real estate. And I believe it's Flipping Houses for Rookies, right, Bill?
That is correct, yes.
Yeah. So I think I'd mentioned to the listeners that I've had some experience flipping houses. So I said, oh, well, I'll have a listen here. I probably know a lot what it's on here, but I was very pleasantly surprised to learn that I knew almost nothing of what Bill was talking about. And that's why I'm really excited to have Bill on here today. And what I'd like to talk about is Bill mentioned 7 core ways, I guess, to make money from real estate. And a couple episodes ago, I talked about one of those in my 6 ways. And one of those is flipping houses, which could be many episode podcasts. And I think that's pretty self-explanatory, at least how that works for most people. But or what's not evident, I would say, are these other ways that you have detailed to your listeners how to make money in real estate. Tell me a little bit more about that, Bill. What are those ways? And then I'd like to kind of go through those a little bit in greater detail.
Sure. So I'll list all 7 and then we'll omit the one that you've already spoken about, okay? So the first way is what I call a SLOT deal. It's an acronym for Sandwich Lease Option Transfer. So basically that's if somebody doesn't have a lot of equity in their property. The second one is just using an option, which is much like stock market type stuff where you can buy the rights to sell a property. And because you're an equity share in the property, you don't need to have a license. The third way is to actually do what we call rent to own, where we actually rent from our seller and then sublease it to our buyer. And that's probably my most profitable transaction and the least risk and all that kind of stuff. So if somebody's starting out, that's like a great place to start. Number 4 is where we actually get the deed or we acquire the unsumable mortgage because nowadays mortgages have a due on sale clause and they're not assumable. So what we do is we take the property out of the person's name, put it into a trust, and then we manage the trust and we end up owning the property. The 5th way is the one that you probably talked about, which is the standard fix and flip, rehab retail. That's the most common way. And then the 6th way is wholesaling, where you actually assign contracts. You get something under contract and you assign it for a fee. And then the 7th way is owner financing, where the seller actually carries back a mortgage. And it's pretty interesting how that could be set up so that it's very profitable for the seller and for yourself.
Okay. Yeah. Now, I meant to ask you to talk a little bit more about your background before I jumped into grilling you on these ways to make money. I was so excited at how we could make money here. Tell me a little bit about your background. How did you get into this? How did you get into having the podcast?
So I've been doing this for about 20 years. I've done hundreds of transactions myself. I also teach it, as you're aware, and I've probably helped hundreds of transactions with private coaching clients and helped them with the different ways. The podcast is kind of a strange story because I had a friend of mine come to me and say, hey, can you help me with flipping houses? Because he went to one of those seminars, in a hotel somewhere.
Paid $25,000 to go to the seminar, probably.
That's what they were trying to get him to do, right? They were trying to get him. He went for a $400 seminar and they were trying to sell him a $25,000 package, right? So he's like, well, my friend Bill does that. So he came to me and he's like, how can, let's hook up. If I get a deal, I'll split it with you. And I'm like, why would I want to do that? I mean, I get my own deals. I want to pay you 50% just for finding a deal. I mean, that's like, I'm going to have to do all the work because you don't know what to do, right? And I've known him for 20 years. So he was like, yeah, that makes sense. So what happened was he's like, well, what can I do for you? Let me think about it for a couple of days. So that turned into, I always wanted to do they had this podcast once. I don't know if you remember Frick and Frack, where they talk about car repairs and cars and all that stuff. And I remember hearing.
I've never heard of that, but it sounds interesting. Yeah.
Yeah, it was a national thing. So I'm like, let's go on the radio like those two guys and talk about houses. So I paid for 13 weeks of being on a radio station, and we went on the radio every week for 13 weeks. And I was like not impressed because the radio station couldn't tell me like who was listening to us and what my demographics were. And there was no real call to action. We were trying to get people to go to a website, and it was just kind of messy, and it was not cheap. So my daughter said to me, well, how about a podcast? I said, how about a what? And so she kind of guided me through that. My oldest daughter, and then my youngest daughter ended up being an assistant for me, and she's obviously a lot younger than I am. She was at the time in her mid-20s. So we just kind of like just started. I didn't know anything about it, and we just started, and now it's 5 or 6 years later, and I think we're recording episode number 265, and it's kind of weird because I don't normally do guest speakers, or I haven't been. It's just been myself and this guy, Pete, who's the rookie. And he's always taken the perspective of like the listener being the rookie, and he would ask me questions, and we just talk about a lot of creative real estate deals, mostly around these 7 strategies I was just talking about. And what are the pitfalls? And so you can see them before they happen. And what are the advantages? And why would a seller say yes to that? Why would a buyer do this? And we just talk a lot about a lot of topics, all kinds of stuff.
Well, let's talk more about how to make some money, what those ways are. So if you'll take us maybe briefly through those 6 and just explain a little more how it works and what some of the pros and cons are.
Yeah, so I think the important thing to understand, and without going into the weeds, and I hope this is okay, we talk about this, is an option agreement. You know, like on the stock market, you can buy a stock, or you can buy the rights to a stock.
Sure.
And then you can go sell it. So once you have the right, like we talked about the other day, you got Apple stock, we'll say Apple, and it's $400. Say you buy the right to sell that stock for $10. And as long as it goes above $410, you can sell it, make money. So houses are the same way. So you could get the seller to give you the right to go sell this property. And it could be for 30 days, the rights. You could have it for 90 days. I've done them for 10 years. You know, so the seller can give you the rights to go sell this property on a predetermined price and on a predetermined amount of time. You know, sometimes I'll make payments, sometimes I won't. You know, it depends on how it's structured and what we're doing. And that's the magic, is understanding the option portion of it.
So that's the slot deal you're talking about?
Yeah, so we use that on the first 3. So that's the sandwich lease option, that's the option deal, and that's the rent own, is that ability to do that. So I'll get the difference there in about 2 seconds. So once you understand that you can buy the rights and you sign that option agreement, technically what happens is you get an equity share of that property. Now, it's a very minute equity share. It's not a controlling equity share. But because you have that equity share, you can go sell this property and don't need a license. So this is what we did. I mean, I won't get into the whole thing because we don't have a lot of time, but, you know, realtors didn't really get organized until about 1949. So the question you have to ask yourself is, how did we buy and sell property before the realtors?
Nobody sold anything, right?
Yeah. And this is how we did it, right? Is with these kind of transactions. So what I do, you know, I just learned the very old-fashioned ways of doing transactions before realtors were around. And lawyers understand it, and they're all legal, and everything is cool because prior to 1949, that's how they did everything, right? So what happens is like what we call the sandwich lease option transaction, which, by the way, it was a joke when we first came up with that, because I told Peter, a slot deal is like going to the casino and putting in $10 and pulling a lever and getting out $10,000, right? That's how it started, right?
Doesn't sound like a good investment. Only for the casino.
Yeah, exactly. So what happens is you can go find a seller that's willing to actually sign this option agreement with you with a rental contract. So suppose somebody owes like $100,000 and it's worth $100,000 and they don't want to pay the closing costs because they don't have the money. You can promise to pay them $100,000, go find a buyer, an end user, sell it to them for $105,000. They'll give you $5,000 deposit, and then they'll owe the $100,000. So then you just take your seller and your buyer and you put them together. You bought the option agreement for $100. You know, if you gave them $100 deposit, your seller, and you sold it for $5,000. You never really bought and sold the property. You just bought and sold the option agreement and attached a rental agreement with it.
So let's work through that. So if you have closing costs, right? Let's just, I don't know, say they're 2%, right?
There are no closing costs.
I thought you were saying the seller would have to pay couldn't have the money to pay the closing costs.
Right. So at the end, when your buyer actually, a year or two down the road qualifies for a mortgage, because they're going to rent it from you.
Oh, they're going to rent. Okay. I heard you say rent, but I didn't understand how that came in. Okay.
Yeah. So the buyer will rent until they become qualified. But here's the thing. They're not regular renters. They're renters without landlord obligations because they're with the option agreement. They're actually purchasing the property. So, it's kind of like if you have a rental car. Are you going to wash it? Are you going to change the oil? Are you going to take care of it? No, you're just going to use it and go away, right? Where if you own it, you'll take care of it. So these buyers are under the premise that they own it, which they do legally, and they're going to take care of it. And then when they will get their mortgage, they're going to close with the seller. But the buyer is aware that they're going to pay the closing costs. So the seller doesn't have to do that.
Okay. Oh, I understand. Okay. Yeah, that makes sense. So does that money, the $5,000, do you get that once this deal is signed, or do you get that when the house actually sells?
Once it signs, and most of these transactions we do within a 30-day period. So when we find a seller, it doesn't take us long. We usually go on Facebook or Zillow, one of those, and we just advertise house for sale, no bank qualifying, or house for sale, rent to buy, rent to own, and we find qualified buyers. We'll do all the paperwork, or I'll do all the paperwork for the seller and for the buyer, and I get paid $5,000 to do that, just to do the paperwork. And of course, I'm using $100,000. If it's a $200,000 or $800,000 house, the fees change. Yeah.
If they don't have any money to pay their closing costs, how would they pay you the $5,000?
Because you're asking $5,000 above the $100,000 you're offering to pay them.
Oh, okay. So they're paying the $5,000. That's like their deposit essentially to buy the property. Oh, all right. Okay.
Yes. So if we signed an option agreement for $100,000 and then we sold it for $105,000, they would give us a $5,000 deposit and still owe the $100,000.
Okay. Makes sense. And if they don't ever close on the property, then they probably lose their deposit, right?
Yes. So that's very important what you just said, Ryan. That's crucial because the money they're giving you is a non-refundable option deposit. Just like in the stock market, if you put up that $10 to buy that Apple stock, if you don't purchase the stock, you lose the $10. You just bought the rights to it. You didn't buy the stock. It's the same way in the house. So if they put up $5,000 to have the rights to buy this property and they don't perform, then they lost their rights and they lose their money. They're non-refundable deposit. Now, that's a slot deal. If you go down to the third one, which is a rent to own, it's the same exact transaction, except when I do that transaction, I like to have 15% worth of equity and 20 or 25% worth of cash flow. The difference between the two of them is the first deal, the slot deal, I don't stay in the deal. I don't manage the property. It's in and out in 30 days usually. And then when I do the rent to own, because I'm making 15% worth of equity and 20 or 25% worth of cash flow, I stay in the deal. I collect the payments. I'm responsible to make sure that all that's there because I'm making money.
Okay. So why would you choose one over the other?
Well, I don't choose, the seller chooses. So it's what the seller's willing to do. And most of the time, it's because they don't want to deal what they consider landlord. They don't want to worry about collecting the payments and having any problems or anything like that. They prefer to have somebody like me that's got a lot of experience with that, do it, and then they just get their raw check every month and they're done.
Okay. But they also want to sell the property at some point, right? They want out, but they're willing to not be the landlord for a little while to get out, I guess, right?
Well, if they get out now, they're going to have to come to the table with their closing costs, and they don't want to do that. So the advantage to them is they're going to save, 10 or 12 or 14% in closing costs. But also think about this. If they owe 100 and it's worth 100, they're not getting anything out of it anyways. So this is like a glorified property management company that has ownership rights. And as long as we're taking care of it, and the paperwork's very tight, we use attorneys and all that kind of stuff, so that's very tight. And the point is that I'm going to assign my buyer all the landlord rights. They're shoveling the sidewalks, they're cutting the grass, they're unclogging their toilets. I'm doing all of that. So it's done in the paperwork, but it's a sweet deal. And same thing with the rental properties. So when you do a rent to own, you rent from your seller and you sublease to your buyer, you assign all the landlord obligations to your buyer. Like I said, you rent a car, you're not going to wash it and change your oil on it, but when you own it, you will. It's the same concept, right? So it's pretty intriguing.
It is. Yeah. Something I never even thought about.
And a lot of people do it. It depends on the seller. The seller's got to be motivated. They don't have to be desperate. I don't do desperate, like they're behind on payments or anything like that. But there's a lot of people that have more than one house, or they inherited a house, or they got a job transfer, or they're going through a divorce and they can't get the house sold because they owe too much money. There's a whole bunch of reasons why. There are very natural reasons. And that's how it works. That's what they did 100 years ago. It's like, instead of paying them money, they paid them, 13 chickens and 2 2 cows and a horse and whatever they did. You know what I mean? But the interesting thing is that if for some reason the deal goes sideways, you could just break your lease with them. And I mean, they won't be happy about it, your seller, but there's not any legal ramifications. You're not applying for loans. You know, you're not worrying about rehabs, you know, because I mostly do this on pretty houses, not ugly houses. So you don't have to worry about fixing them up and, you know, all that type of stuff. It's a great way for somebody to get started, you know, and get used to doing transactions and dealing with sellers and buyers. And it's a really cool thing to do.
Yeah, because that's the tough thing is that, you know, when I talked about the other ways to make money with real estate, those were all investing your already accumulated principal or retirement money, right? So if somebody's looking to get into real estate, one of the biggest hurdles is having money to get into it. And I guess this could be a way to get into it and or also make money in the process to be able to maybe flip a house down the road or buy a rental property, I guess.
Exactly. But think about what you're saying there, because what you're saying is if you have capital or have the ability to get capital, you're actually buying and selling the house. What I'm buying and selling is the paperwork that owns the house. And I'm buying and selling the financing, not the house. See, so when I say that, you know, I can give, you know, a house for sale and no bank qualifying, I get to pick the terms with the buyer, how much they're going to put down, how much they're going to pay, how long they're going to go, all of that stuff. So they tend to buy houses that have little quirks to them, you know, like the rugs need to be replaced. Well, they'll do that. Or a lot of times we'll sell them on handyman specials. You know, if there's little things, you know, the wall needs to be painted or something like that, the owner will do it because they know that they can't get a no qualifying loan on every street corner. So we're actually buying and selling the financing. What you're talking about, the fix and flip, you're buying and selling the house. And it's just a different strategy. They all work. It just depends on where you're at in life and your resources and, you know, what you can do. So it's pretty incredible. I mean, I've helped a lot of people do this. I've helped a lot of people find these deals. That's the hardest part, is finding them. You know, it's not that it's hard. It's just that you've got to send out a lot of feelers. I own a 3-family house in New Haven. I've owned for like almost 10 years. And I was cleaning out some paperwork the other day. And I actually came across a letter that I had from you, not knowing it was you. I was looking at this letter because at one point I was looking at selling it. I'd had enough. And I held on to this letter and I realized it was from you. So interesting. I'm blushing.
Yeah. So obviously you've got to get the word out about this because people probably don't even know this exists. And then secondly, how do they even find someone like you? So you're probably sending some mail out to let people know certain zip codes or however you do it, right? Right. So my biggest drum that I beat is you get paid to do, not know. And most people don't realize that. It's like, you know, my tagline on that is, well, have you rented a place to live? Like maybe when you were in college or whatever, you rented a place to live and you signed a lease with a landlord, right? Yeah. Well, you know how to do this. You know, it's really just that simple. I mean, it's not any more complicated than that. And we use Facebook Marketplace a lot to sell our properties. It's a great place to go. And, you know, when you advertise, you know, house for sale, no bank qualifying, it really does. You just got to do it a few times. And because there's no risk, you know, then, I mean, especially with an option, because the option gives you the ability to perform or not to perform. And if you don't perform, you just lose your deposit money. So the way to not lose money in real estate is don't put money in. So if you're only using $100, that's your risk. So that's the magic of it is to figure out how to use that low, you know, so if you need to learn, then only put $100 in to get your education. So that's enough to get people to sign this option with you think? Yeah. Okay. Yeah, because their motivation is not money, especially somebody that owns like $100,000 house and they owe $100,000 and they're looking at, you know, $8,000, $10,000, $12,000 in closing costs and they don't want to kick that money in. So they become an accidental landlord anyways. You know, they're going to put somebody in the property and rent it. So this gives them the choice. Well, I can still get my money. I can still make my payments and I don't have all the liabilities of being a landlord. So it's a perfect deal for them. And at the same time, you know, it's a good deal for you because you're able to make your few bucks and there you go. Do you want to talk more about the other ways? Yeah. So I just covered the slot deal, the sandwich lease option transfer. I covered the option. I covered the rent to own. The only other one that I could talk about briefly, which is a very deep subject, but a lot of times we'll take over somebody's mortgage payments. Like I just did one last week. And the way we do that is technically there's only 4 entities that can own a piece of real estate. And those 4 entities are your personal name as an entity, an entity itself like an LLC, C corporation, S corporation, something like that, a partnership, and a trust. So basically what we do is we take the property deed out of the person's name, we put it into a trust, and then we manage the trust. And that's how we end up. So
there's, paperwork to go with that. But when you manage the trust, now we're making the mortgage payments, we're doing the landlording, we're doing all that kind of stuff. We're controlling the deed because the deed's in the trust. So if I'm going to put money into a deal, I have to make sure that I have a deed. Otherwise, I don't put money into the deal because I want to protect the money. And that's my favorite deal. That's what I started doing 20 years ago. Its nickname is subject to, which means you're acquiring the property subject to the underlying mortgage already. So it's harder to explain than actually doing it. But basically, once you put the house into a trust and you manage the trust, it does all that for you. Which, by the way, that could be a confusing subject on trust because there's so many different types of trust. What I'm talking about is a property trust. So the only thing that's in the trust is the property. I'm not talking about a family trust. I'm not talking about all that other kind of stuff because that could...
Irrevocable trust, yeah.
Yeah, all that stuff gets very complicated. I do this with it's called a warranty deed of trust. So when they sign my deed, it not only warranties the property, it also, saying that there's not something wrong with the title, it also changes ownership and it puts it into a trust all in one fell swoop.
And this could be someone with a mortgage?
Yeah.
The banks that's not an issue, obviously, I guess, right?
No, because we call the banks and tell them we're going to put the house in a trust and I'm the trustee and we're going to be paying you from now on. And especially if the seller has been having trouble with payments, we're going to pay on time. I mean, I can't tell you how many of these transactions we've done where we've improved people's credit scores and helped them get other, the biggest objection is they think that if they do this, they can't get another mortgage. Well, I help them get another mortgage. There's ways to do that. That's not a barrier. It's just a lot of experience.
Yeah.
The point is it can be done. That's all we're talking about today.
So what is it that you get out of this? You sell the house down the road and you make the difference, or?
Yeah. So I have a scale. These scales that I'm talking about, like the slot deal and the option deal, I have mathematical formulas. Like I start with the loan to value ratio. So I do these deals based on how much equity. So when I'm doing this deal we're talking about, it needs to have about 20% worth of equity or profit. So what I'll do is I'll acquire this property like you're talking about, and then I'll sell it on a rent to own. So, if I'm buying the house, we'll say for $80,000, I'll sell it for the 105. And when they go get a mortgage, that's when I get paid. And obviously there's some profit on the monthly payments. My most basic formula that I use on every transaction is money now, money monthly, money later. So when I'm looking at a deal, I'm looking at, can I make money now with the deposit? Can I make money monthly with the rent? And can I make money later with the equity? Right? So I just kind of look at that, and that determines how much time I spend on a deal. So if I'm just going to make money now, like on the slot deal I was talking about, I'm not going to spend a lot of time on that deal, 10 hours, 10 hours, something like that. If I'm going to make, like I just did a transaction and we made $93,000. I spent 2 months on that deal. You know what I mean? So it's because I had $93,000 to make, and they're more complicated deals. But that little simple formula keeps me guided on what I should be doing, what I shouldn't be doing. So that covers the slot deal, the option deal, the rent to own, and then the getting the deed. And then the other ones are just kind of common. The rent to own, you buy the ugliest house in the nicest neighborhood. You already talked about that. Wholesaling, I don't really believe in that. That's kind of an old strategy. That's where you're buying a house at 50, 60 cents on a dollar. You're dealing with desperate people. And, you buy it for $40,000 and you go assign the contract and make $5,000 to have somebody buy the contract from you.
Yeah. Or you do like simultaneous closings, right?
Yeah. And banks are getting really clever with that.
Close in one room, sign it, and then go in the other. I mean, I've never known anyone to actually do this, but that's how you're supposed to do it, I guess.
It's harder these days. There's actually a new industry called intermediate loans, and they lend you money for like 2 weeks or a month so you can do that kind of stuff. But I don't think that's a good business. That's a very rickety business. And then the last one, just on a quick note, is owner financing. And my core strategy there is that I pay full asking price often. It's usually done on a free and clear house, so they don't have a mortgage. So I'll absorb the 12, 14, 15% of closing cost. I'll absorb that. So the seller is getting, so if they're selling for $100,000, they're not going to pay $15,000 in closing costs. I'll pay $100,000. Sometimes I'll pay 5 or 10% more. I'll pay, 105, 110. The trick is, and it's not really a trick, but the mathematical procedure is when I pay like that, I get principal only mortgages. So there's no interest. And that's what allows me. So if I have to pay interest, then it goes back to the regular number. But instead of giving them the interest money that has to be claimed as income every year, I give it to them in equity, and often they can have tax savings on it. So that's a whole nother subject. I do well with that because I like to do principal only mortgage payments, and those are amazing deals. And I sell those on a rent to own too. 81% of the population, this was pre-COVID, I don't know what it is after COVID, doesn't qualify for a mortgage that are looking for houses. So I deal with that 81% and allow them to do a rent to own. They still want houses, and as long as they have a chunk of dough, which a lot of them do, $5,000, $10,000 to put down, and they can financially swing the mortgage payments, then they can buy a house. Where before they couldn't, before the banker was telling them that they can't, but they still want a house. And this is like that intermediate way to do it. But the owner financing, my favorite are getting the deed, the subject twos and the owner financing. Those are my two best deals because it gives me I like the money now, money monthly, money later formula. When you do a flip, you get one paycheck at the end. You got to work hard for 3 or 4 or 5, 6 months. You get a big paycheck, but you get one paycheck. With these other ones, you get a paycheck now when you sell, and then you get a paycheck every month, and then you get a paycheck later on. And that's why I like those deals because you work once for the asset and you get paid multiple times. So that's why I like them. And we're kind of breezing through them because we don't have much time here.
Well, yeah, I mean, you have, like you said, 250 something episodes. So there's a lot to cover, obviously. And, I would think people are more interested. They could check out your podcast. And is that your website as well?
Yeah, it's Flipping Houses for Rookies, either on the podcast or the website. It's flippinghousesforrookies.com. And I give away a lot of free stuff because I make my money with real estate, not in education. I just happen to fall in the education business kind of by accident. So I give a lot of stuff away. And I kind of have I call it the Henry Ford model. Henry Ford had this motto that every American should own an affordable car. I feel like every American should have the right to do real estate because it's a fascinating tool. It's a really good tool for making money to pay debt or go on vacations or retirement or whatever. And the guys that know how to do it try to keep it complicated because they don't want the arena to be full, and I'm not like that. There's plenty of deals for not everybody to go around. So I try to make sure that I help as many people as I can. It's just karma.
Sure. Yeah. Well, thank you very much, Bill. Thanks for shedding some light on these non-traditional ways to make money in real estate.
I hope I didn't rush it too much and confuse somebody, but like you said, they can go check out the podcast.
Well, look, like you said, you make money by doing, not knowing. So, the more you do something, the more you understand it. So I think people can look more into it and get some more out of it if they want to. So thank you very much.
You're very welcome. Thanks, man.
This concludes my 4-part series on real estate. And if you haven't listened to the previous 3 episodes, either 1031 exchange rules, 7 things to know about investing in rental properties, or 6 ways to make money from real estate, please go back and check out those episodes. And if you're enjoying this podcast, please subscribe on either Apple Podcast by pulling out your iPhone and searching for Retire with Ryan, or on Spotify. I hope that you have a great week, and I look forward to talking to you next Wednesday. Take care.
You should consult a financial advisor familiar with your specific circumstances before you make any financial decisions. Nothing in this broadcast constitutes a solicitation for the sale or purchase of any securities. Any mention of rates of return are historical or hypothetical in nature and are not a guarantee of future returns. Ryan Morrissey, CFP, is an investment advisor representative of Morrissey Wealth Management, LLC, a registered investment advisor.